Hey everyone, we wanted to take some time to update you on the markets and the economy. It's been a rough year so far. During most market declines, we actually see an increase in bond prices because by nature, people sell stocks, which are perceived to be more risky, and take their money and move it to bonds, which are perceived to be less risky. However, this time has been a little bit different because the Fed has continued to raise interest rates throughout the year. This has actually caused a decrease in bond prices, and we've actually had one of the worst bond markets ever in history. So if you pair that with the decline in the stock market, even a moderate and conservative portfolio has declined considerably so far this year. However, this comes on the back of a strong bull market. So even with the recent declines, most investors have seen good gains over the past few years. Now, all of the talking heads are turning to a possible recession. What is a recession? A textbook definition of a recession is 2 quarters of declining gross domestic product, or GDP. So by definition, we have actually seen a recession and we're probably in a recession. However, the data actually suggests something different if you look at the rest of the picture. Typically when we see a recession, we do see the declining GDP, but we also see a spike in unemployment and a decline in corporate profits. However, right now we're still seeing low unemployment rates and corporate profits or corporate margins typically remain in double digits across the board. This has not happened since World War II. And so we're getting conflicting data on a lot of different sides of the table. But in early July, some information came out that the Fed may actually back off of their increasing the interest rates going into next year. When this information came to light, we actually had July being the best month for the market since November of 2020. However, the markets tapered off after the Fed came out with their hawkish stance after their meeting in Jackson Hole a few weeks ago. So where are we really at today? Corporations are sitting on large amounts of cash. Unemployment remains low. Corporate profit margins remain high. Inflation is actually starting to decline, and in some pockets of the country, we're actually starting to see deflation occur. We're also in an election year, and election years typically bring volatility. Leading up to the election, you will usually see lots of market swings one way or the other based on different economic data and different political opinions that are coming out. However, after the election, the markets usually rebound and head north. So where do we go from here? It's possible that the markets continue to decline. However, we have a good time in history to look at where the Fed has been very hawkish and the markets have actually come out of that and done quite well. If we look at 1982, the Fed continued to raise interest rates and the markets actually started recovering well before they finished their interest rate increases. What the markets will do is yet to be seen. But remember, markets move quickly. With just a little glimpse of good news, July was a great month for the markets, and we actually recovered almost half of what the markets had declined for the year. So as we enter the final few months of the year, we're keeping a close eye on inflation, corporate profits, and the overall state of the economy. If inflation continues to decrease over the next few months and corporate profits stay high, then we believe the markets will continue to move north from here. In fact, there are a lot of analysts out there that believe that the market will actually hit an all-time high by early next year. So what do we and what do you need to do about all this? First, keep in mind that it's generally better to spend time in the market than to try to time the markets. If you try to time the markets by selling when the markets are bad and buying when things are getting better, it's very difficult to get the timing right. And data shows that if you just spend time in the markets and stay invested, you'll have a better success rate over time. Second, look for opportunities to invest. Baron Rothschild is credited with saying, "The time to buy is when the blood is in the streets." He made a fortune by buying after the panic following the Battle of Waterloo against Napoleon. And Warren Buffett is credited with saying, "Be fearful when others are greedy, and greedy when others are fearful." Let's take a look at your personal situation to see if there are opportunities to take advantage of the recent declines and buy good companies while they're on sale. We at Gunter Financial Services continue to monitor the markets and the economy and look for opportunities and changes that need to be made. We're here for you, so if you ever have questions or concerns, don't hesitate to reach out. Thank you for taking the time to watch this video. We hope that you found it helpful, and we plan to continue keeping you informed through this method going forward. Have a great day.